Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. In this video, we're just going to be exploring a unique and powerful trading approach that helps you manage your risk effectively, right? Now, it's not as if it eliminates risk, okay? It doesn't eliminate risk, but it can help you to, manage your risk to an extent, right? Now, the name of this concept is triple hedge Forex, right? Triple hedge Forex strategy. That's what we're going to be discussing in this video. So if you're looking for a way to stabilize your trades and minimize exposure, then this video is for you. Stick around and by the end, you'll know exactly how to use this strategy to enhance your trading game. First of all, let's just quickly talk about what the triple hedge Forex strategy actually is. All right. Now, triple hedging is a method where you trade three currency pairs that are correlated or share common currencies. Okay. The three pairs have to be correlated and share common currencies. All right. The idea is to create a balance between these pairs to reduce overall volatility in your portfolio. For example, let's say you are trading Euro USD, maybe USD JPY and Euro JPY. That is the Euro against the dollar against the yen, Japanese yen, and the Euro against the yen again. So if you're trading those three pairs, you will notice how these pairs share common currencies, right? I'm just going to write them out. Okay, so imagine you're trading Euro USD, right? And USD JPY, right? And Euro JPY, right? Now, these pairs have common currencies, right? Euro here and here, USD here and here, JPY here and here, right? Euro in the first, Euro and USD in the first, USD and JPY in the second, and Euro and JPY in the third, right? So by trading all three, you are hedging your exposure to individual currencies while taking advantage of their interrelationships. All right? Now, this approach is especially useful in markets with high volatility or when you want to protect yourself from unpredictable price movements. All right? Now, this approach is quite an effective approach, right? If done properly. So now let's just quickly break down how the triple hedge strategy works. Step one is identifying the right currency pairs. Okay, you want to pick pairs that are either positively or negatively correlated. Now, correlation measures how two currency pairs move in relation to each other. For example, positive correlation, when one pair goes up, right? When one pair goes up, the other tends to go up as well. That's what we call positive correlation. And we're just going to be looking at a practical example right now. So this is the Euro USD chart. This is the 1 hour chart for the Euro USD. I'm just going to go to the GBP USD as well. I'm going to go to the 1 hour chart as well. And as you can see that the Euro USD is on a bullish trend. Now the GBP USD is also on a bullish trend. So this is what we call positive correlation. All right. When one pair goes up, the other tends to go up as well. The negative correlation is when one pair goes up, the other tends to go down. That's what we call negative correlation. And we can see that around the USD JPY and Euro USD. So I'm going to go to the 1 hour chart for the USD JPY. And as you can see, the USD JPY is currently in a sell trend while the Euro USD is in a buy trend. So that's what we call negative correlation. Now, you can actually use tools like a Forex correlation matrix to check the strength of the correlation between pairs. Okay. Ideally, you want pairs that provide balance in your portfolio. If one pair moves against you, another may help offset the loss. Okay. So once you've selected your pairs, the next step is determining your position sizes. Now, balance is key here, right? You'll need to calculate your lot sizes carefully to ensure that no single pair dominates your portfolio. For example, if you are long on Euro USD and USD JPY, right, you might consider a short position on the Euro JPY, okay, to balance the exposure, okay. So a simple setup is, a simple setup is to buy Euro USD, right? This benefits from strength in the euro and weakness in the dollar, right? And then to sell USD JPY. Now this benefits from weakness in the dollar and strength in the yen. And then to buy Euro JPY, right? Now this benefits from strength in the euro and yen, depending on their relative performance. Okay? Now, why should you use the triple hedge strategy? Let's talk about the advantages. Okay? The first is reduced volatility. So, hedging balances your exposure and makes your portfolio less sensitive to sudden price swings. Okay? Also, by trading multiple pairs, you are not putting all your eggs in one basket. Okay? That's in terms of diversification. And then with respect to flexibility, this strategy can be adapted to suit trending or ranging markets. Okay? But like any strategy, triple hedging is not perfect. Okay, here are some challenges to watch out for, and one of them is complexity. Managing 3 trades at once requires attention to detail. And then in terms of correlation changes, correlations between currency pairs can shift over time, affecting the effectiveness of your hedge. Okay, and then transaction costs. Trading 3 pairs means more spreads and commissions, so make sure your potential returns justify the cost. All right, so that is the triple hedge forex strategy in a nutshell. It's a fantastic way to manage risk and diversify your trading portfolio. But like any strategy, it requires practice and precision. Start small, test it on a demo account, and tweak it to match your trading style. If you found this video helpful, don't forget to smash that like button and subscribe to the channel for more forex trading tips, strategies, and insights. I'd love to hear your thoughts. Have you tried triple hedging before? Share your experiences in the comments below. Thank you for watching, and I'll see you in the next video. Until then, happy trading.